Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
This is Mike. Can you hear me?
Yep, we hear you loud and clear. Okay, great. All right,
All
so
right.
I think we are ready to start. First of all, thanks everyone for joining us this afternoon. Today's session is going to be hosted by the great Mike Tosaw, who will be teaching us about ETF correlation and is it good or bad. Mike is the man behind many online tutorials and live webinars. He's known for his ability to cover questions that range from the simple to the most complex. His audiences around the country include online traders, members of investment clubs, and independent representatives seeking education about online stock and options trading. So at this point in time, without any further ado, I'm just going to go ahead and turn it over to you, Mike. Thanks.
Thank you. And real quick, just to make sure, if you guys can just, if you guys are able to hear me now, please just type a yes in the chat box, or just write something in there. Okay, very good. Just wanted to make sure that everyone can hear me. So, welcome everyone to today's presentation on ETF correlation. I have to say it's always a pleasure to be doing presentations with the ISE. It's always a lot of fun. The ISE has a lot of great products, and we're always very excited at Know Your Options to work with the International Securities Exchange. Before we proceed any further, we do need to mention that options do involve risk, and we strongly recommend that you read the characteristics and risks of standardized options in great detail before placing any option trade. You can find this document at knowyouroptionsinc.com, our website, and it's also available at ise.com. So before anything, make sure you read that document. It's very important to have a good understanding of the risks involved in trading before actually pulling the trigger. Now, my plan for today, everyone, I plan to talk for maybe 40 minutes or so on the topic at hand, ETF correlation, and we'll be adding a few things into this in terms of like how options play a role in it and that type of thing. But what we'll do is at the end, we'll open it up for questions, and you'll be able to type the questions in the chat box, and I'll answer them to the best of my ability. Excuse me. In the meantime, if you do have any questions that you really want to have answered during the presentation, I'm fine answering them during the presentation, but if it's something that can wait till the end, I would ask that you wait till the end to just kind of be respectful for everybody's time. Points to ponder for today. We're going to be going over the broad market. And when I say the broad market, I don't mean just the broad stock market, such as large cap, mid cap, small cap, which we'll also be talking about as you can see in the next bullet point. I mean the broad marketplace, gold, silver, commodities, the whole 9 yards, how it actually applies to you and how it might be able to give you a different viewpoint on what's actually out there. Don't get me wrong, I love the stock market. I think there's a lot of great things to it. But I think that's just a small piece, not a small piece, it's a significant piece, but it's just a piece of the investment world that actually exists. We're going to be going over correlations with small cap, mid cap, and large cap ETFs. We're going to be going over correlations within a sector. So for example, if you're bullish on energy, we'll be talking about that. If you're bullish on the financials, or if you're bearish on industrials, or you're bearish on financials or energy, whatever the case may be, we'll be talking about correlations having to do with sectors. We're going to be going over customizing your exposure. Folks, the way with which traders typically look at investing as well as trading is along the lines of not how much can I make doing this investment, but how much do I stand to lose if I'm wrong doing this investment or trade? And what we're going to go over is talking about how you can actually make the exposure work the best for your specific situation. We're going to go over the benefits and drawbacks of the actual correlations that exist within the ETFs. And we're going to go over the ISE ETF, in particular FCG. We'll be talking about that a little bit today. And then at the end, we'll talk a little bit about what we do at Know Your Options, and then we'll open it up for questions. So we have a lot to cover. Let's get after it. Folks, in terms of the broad market in the stock world, there's several ways with which you can categorize your exposure by using ETFs. Let's say that you're looking to customize your exposure based upon the size of the market. Well, you have the Russell 2000, you have the S&P mid-caps, and then you have the S&P 500. Those are probably the three major indexes that people look at in terms of small cap, mid-cap, and large cap. With this, the three ETFs that a lot of people look at, or at least that we look at Know Your Options, they're pretty common throughout the industry. IWM tracks the Russell 2000, MDY tracks the S&P mid-caps, and then SPY, the classic, the spiders, tracks the S&P 500. And they're very simple in terms of the exchange-traded funds. If the market goes up, you're going to make money. If the market goes down, you're going to lose money, assuming you are long the ETF. ETFs, they trade just like a stock, meaning that you can buy and sell them all you want, basically. There's no, it's not like a mutual fund to where you only have pricing renewed once per day or 2 or 3 times a day, just depending on the mutual fund itself. These ETFs trade just like a stock. Now, another way with which you can categorize your exposure is based upon sectors. And the second bullet point shows all of the XL ETFs. This is a technical term that we refer to over at Know Your Options. This is highly advanced. We call these the SCLUs. So with that in mind, another way with which you can customize your exposure in the marketplace is through the sectors. And you can see the 9 basic sector ETFs. Now, let's say that you want to have geographic exchange-traded funds, such as you want to have exposure to Japan, you want to have exposure to emerging markets. There's ways with which you can use ETFs to have exposure that way as well. Now, this is one of my favorite slides I like to do at times, this one as well as the next one. Oftentimes, you'll hear someone say, well, I'm pretty well diversified in my portfolio. I have exposure to small caps, I have exposure to mid caps, and I have exposure to large caps. And you'll have the different percentages, and you can argue till you're blue in the face as to how much you should have in each sector of the in each size of the marketplace. And don't get me wrong, I think that's important, but folks, the bottom line with anything is if the market goes up, small caps, mid caps, and large caps are probably all going to go up, and if they go down, they're probably all going to go down. Like I said, you can argue till you're blue in the face as to which one you think will perform better or worse, but this is actually a graph from the 3 ETFs with which we described on MDY, IWM, and SPY. This is a comparison over the course of approximately the last year. Now, granted, you can see that the mid-caps look like they're winning right now, and then the small caps are in second place with the large caps lagging behind. But in reality, folks, you can see at different points throughout the year that there were different leaders and different followers, but for the most part, over the course of this year, they're going in the same direction. Now, at times, for trading purposes, yeah, there's going to be times to where you can do pairs trading or things like that, and that may be an opportunity for you. But in terms of correlation, the point with which I want to make on this is that if the market goes down, just because you have, if we lose 40% in a year like we did in 2008, just because you have the right allocation to small cap versus mid cap versus large cap, you're still probably going to end up losing money. That's the bottom line on this. Now let's take this a step further. Let's customize this by sector. This is a chart of the last year of how the sectors performed that we just described. The industrials, consumer discretionaries, the financials, technology, healthcare, utilities, etc. And on here you can see that they've moved all in a similar direction as well. In case you're wondering, the one that's on top right there, the green line, that's energy. And you'll notice that that one started pulling away around January. And as time went by, a lot of the reason for that, and especially in February, with everything that was going on with Japan, with what was going on in Libya, so I really believe that was kind of the catalyst as to what, and I imagine a lot of people in the market would agree with me on that. That was the catalyst as to what was driving the energy stocks. And I think there's no question that this has been an energy-driven rally that we've had in the marketplace, at least for 2011. So once again, just because you might be a little bit or just because you have diversification within sectors, you can see that they're going in kind of a similar direction on here based upon where the market is actually moving. So let's say that you're a sector person, and this is kind of what you're thinking, because this is a little bit of the way with which I like to think when I'm using long-term investments for clients' portfolios. And with that in mind, we use options for them, and we'll talk about how we incorporate options in the long-term investment portfolio in a few more slides down. But on here, let's say that this is what you're thinking. And just so we know, full disclosure, this is not what I'm thinking, but this is what you may be thinking as you're looking at the various sections of your stock portfolio. Hey, Mike, I believe financials are overbought. How can I get out of some of my exposure to them? Well, the obvious answer would be something along the lines of maybe lessening your position in XLF. And once again, this is under the assumption that this is the way with which you diversify your portfolio, and you think maybe XLF has had a little bit too much of a run, and you want to get out of it. You want to maybe get a little bit less exposure in there. That's one of the basic ways with which you can do this. And once again, I have no problem with that. This is what's known as reallocation. In other words, let's say one sector gets overweighted. You can move funds to reallocate the money to your original plan. So let's say, for example, that you wanted to have 4 different ETFs. All of them are diversified in the way that you like, and you have 4 different ETFs, and all of a sudden ETF number 1 goes up a ton, but ETFs 2, 3, and 4 just stayed the same. Well, by doing that, and you want, let's say, equal exposure to all 4 of them, by doing that, all of a sudden you have extra exposure to ETF number 1 because of the fact that it's increased in value so much. So the reallocation theory dictates that you take your profits, or take some of the profits on ETF number 1 and redistribute them to the other 3 ETFs. That way, you now have equal weighting in all of the ETFs again. Now, usually in the financial planning world, this is something that's done yearly if you choose to do reallocation. But this is something that I've seen done as frequently as quarterly in the investment world. So either way, the concept is that let's go back in time to the late 90s, early 2000s. You make a ton of money in the tech sector. And instead of just leaving it all in tech, you believe that, you know what, I want to go back to my original plan, so I'm going to take some of the profits from the tech stocks that I'm in and maybe put some more money into bonds, or put some more money into dividend-paying stocks or something along those lines. That way, when the tech bubble burst, you didn't have the overexposure to tech. Because a lot of people back in that era, they made a ton of money on the way up, and then they lost a ton of money on the way down. So with that, reallocating is a way with which it can help you to be in a position to where you're sticking to your original plan. Now, a couple ways with which this can actually be done. Like we just described, rotating sectors, meaning that if you feel you're a little bit overweight in one sector, then you can take some of the profits from it and reallocate it to another sector. Now, the second bullet point is another thing that I think makes a lot of sense if you want to incorporate a little bit of short-term into your long-term portfolio. Purposely over and underweighting sectors. So let's say that you're of the school of thought that believes that even though there's a hot sector out there right now, it's going to come down at some point and get back in line to the rest of the market. Reverting to the mean is what this is described as in the trading world. Now, I like this concept just because of the fact that no tree grows to the sky. That's kind of my personal school of thought on this. And let's say, for example, that we're looking at a portfolio where we're using these sectors, and all of a sudden, we get called out on a covered call on one of the sectors. But the rest of them, we didn't get called out on. We're doing covered calls on all these, let's say. We get called out of one of them. Oh, darn it, what do we do? Well, I don't really want to buy back into the stock because the stocks, or buy back into the ETF because the ETFs run up quite a bit. So maybe I can just overweight some of the other sectors and have some more market exposure, and that one ETF that's a little bit too high right now for my tastes, maybe it'll come down, or maybe the rest of the market will catch up to it, and then we can redistribute it into that ETF at some point in time. That's another way with which you can overweight or underweight sectors. Now, taking that to the next level, there's ways with which you can create option strategies to relate to this specific concept. Let's take this to the next level and examine that a little bit further. Let's say that you want to overweight a sector, but you don't want to take on any additional monetary risk. Folks, the strategy I'm about to show, the 1:2 ratio spread, is something that could potentially play a role in creating some extra exposure to a sector that you may not want to spend any additional cash on. Now, in the example that I'm about to show, we're going to oversimplify things. We're going to show just two sectors or two diversified ETFs within an entire portfolio. Now, in reality, at Know Your Options, we typically have a lot more than just, in fact, I don't think we have any clients where we have just two securities in one portfolio. I mean, it does, but then it's part of like a greater piece of the puzzle, but I don't know of any client that we have just two securities for their entire exposure for all of their money. But for the example of which I'm about to show, I think it makes sense to only use two securities because of the fact that it's simpler to understand. Let's take a look. In our example, we have sector number 1 with a 50% allocation and sector number 2 with a 50% allocation. And like I said, within these two sectors, we believe this is a good way to go for the individual client. And we believe that this is a well-diversified portfolio based upon the diversification in the ETFs. And we're fine with these two ETFs just for this example. Sector 1 increases by 10%. Things are going well in Sector 1. Sector 2, on the other hand, decreases by 10%. Things aren't going so well with that. So let's say we do nothing. Sector 1 now takes up 55% of the overall portfolio. Simultaneously, Sector 2 now only takes up 45% of the overall portfolio. Now, like what we were describing earlier, we could take that extra 5% of Sector 1, put it in Sector and sell it, and then buy more shares in Sector 2, and we're back to an evenly balanced portfolio again, and everybody's happy. Let's say that's not necessarily the route we want to go. We don't want to take anything off the table in Sector 1 just because of the fact that we believe it's going to continue to go. Based upon our research, from a technical standpoint, from a fundamental standpoint, from an economic standpoint, whatever the case may be, we do not want to be taking exposure away from Sector 1 right now because we believe Sector 1 has very good reason to advance even further. Sector 2, on the other hand, we still like Sector 2, but we're not in a position to where we can put any more capital in it because it's all tied up in Sector 1 right now. So, with that in mind, what do we need to do? We need to find a way to increase our holdings in Sector 2. And this can be done with an option strategy. Now, once again, as we've described, we typically have clients in more than just these two ETFs. We're going to put on what's called a 1:2 ratio spread. This is an area with which you have the potential to get some free deltas, kind of. And we'll show you how this works in pretty good detail. I'm going to bring up a trade calculator tool, and I'm going to show you a few things to make this visual to where it gives you a good understanding of it. So let's say XYZ stock or XYZ ETF, whatever you want to call it, it's trading at $50 a share. If we buy a 50 call, and let's assume that we have 100 shares right now, just for sake of simplicity. Obviously, if you have 200 shares, make this a 2x4. If you have 1,000 shares, make it a 10x20, etc., etc. But for right now, let's say that we have 100 shares. If we buy a 50 call, that gives us double leverage. We get 100 shares of leverage on the stock, and that one call option gives us the right to buy another 100 shares at 50, and we still get to participate to the upside on it. So we get twice as much upside. However, call options aren't free, unfortunately. We have to actually pay a premium to actually buy the call option. So one way with which we can do this, we can actually sell two, not one, but two 55 calls for $2 each. Basic math, 2 plus 2 is 4. So long as the stock is below 55 at expiration, that $4 in premium will expire worthless, and that finances the cost of the 50 call that we bought. Now, the question then becomes, am I naked? No, you're not naked at all on this trade. The first 55 call that we sold is just a covered call because we own XYZ stock at 50. We're selling the 55 call as a covered call. The second 55 call that we sold is hedged by the 50 call. It becomes a bull call spread. So by doing this, you're essentially using the premium from the covered call to finance the cost of a bull call spread. Let's look at this a little bit further. I oftentimes refer to this as a covered call on steroids, meaning that as the stock goes higher, you have the potential to make twice as much money on it, but if the stock stays the same, you don't get the income factor on it like you would for a covered call. Here's what it looks like. Let's say the stock stays at 50. You don't make or lose anything on the stock itself. And I'm on the top line going left to right now. The 50 call will also expire worthless, $4 loss. But the two 55 calls expire worthless as well, so that's a $4 gain. Altogether, break even on the trade. Let's say the stock goes up to 52. You'll make $2 on the stock. You'll lose $2 on the 50 call, but the 255 calls still expire worthless, and you're up $4 on the trade itself. So notice how if you just own the stock at 52, you're ahead $2, and if you have this ratio spread on, you're up $4. That's a way with which you're creating double leverage. Now, once again, I want to emphasize that this is based upon the thought or on the assumption that you're holding this trade until expiration. A lot of times you don't hold spreads until expiration. This is just a concept with which we're working with because of the fact that this is an ETF webinar, and these are trades that you would typically hold for a longer period of time. Let's continue on this one. The stock goes to 54. You're up $4 on the stock. 50 call, you break even on. It's at 54. So there's no gain, no loss. 55 calls still expire worthless. So altogether, you have an $8 gain instead of just a $4 gain. And you can see how this works at the 55 level as well. You have a $10 gain instead of a $5 gain. Now, we're getting into the territory of the drawbacks of this trade. If you have ever felt the frustration on a covered call where the stock goes through the short strike price and you're thinking, wow, I wish I would have just owned the stock instead of messing around with this covered call, then plan on feeling frustration with this trade too, because it'll be there also. You're limiting your profit when doing so. You're creating double leverage in this case from 50 to 55. However, there's no more upside past the 55 level. So if you believe that the stock's going to go higher, higher, and higher and higher forever, this is not a good trade to get in. But if you believe that you want to get back to even exposure on this to the upside, and you don't see the stock going much past 55 in this case, this could be a way to do it. Because remember earlier, Sector 1, we don't want to take any money out of right now. Once again, Sector 1 can be whatever sector you want it to be, but let's say that we determine we don't want to take any money out of Sector 1 right now. However, Sector 2, we're pulled back a little bit, and we like the idea of having equal exposure to both of them. So to the upside, this is something with which you can do to get a little bit of an increase in the exposure on it. The drawback, if it goes past that 55 level, you do not.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.